Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, today we're going to talk about the exciting news, which was the inflation report came out.
Woohoo!
This is an article from NPR. It says why inflation is losing its punch and why things could get even better. So the number today, I'll read the thing from the article. Labor Department reported Wednesday consumer prices in June were up 3% from a year ago, the smallest annual increase since March 2021. What's more, forecasters say inflation could fall further in the months to come, 3%. Now, what's the Federal Reserve's goal for interest rates long term?
So I don't know what their goal for interest rates is, but I know that their goal for inflation is
inflation
is 2%.
2% inflation. 3% is actually
Pretty close.
Pretty darn close. And it's the lowest we've seen in over a year. So I'm going to put up this chart here. This is the chart. Headline inflation drops further in June. And this goes all the way back to 2012. It shows inflation rate. You can see inflation chugging around at 2%. We had a very stable, economy coming out of the great financial crisis. And then if you look all the way, you see that recession. And what's interesting is we had the recession, which was also the pandemic. And then Fed just chopped rates.
Right.
And then interest rates for home loans went to basically to nothing.
Right.
Huge refi boom, right?
Yeah.
But, and you could see, though, that it was a little too much stimulus.
It was. It wasn't necessarily just the fact that they lowered interest rates to virtually zero. It was all the stimulus money that at that point you had just too much money chasing too few goods because remember, productivity was down because everybody was stuck in their homes in their pajamas, just ordering off of Amazon and watching Netflix.
Right. So what's interesting, though, is, you can see, though, that the trend in inflation, which is that yellow line, the 4.8%, I think, excludes, that's core inflation. The 3%, though, core inflation excludes food and energy. So food and energy, gas prices are down substantially. Food costs the inflation in food isn't as bad as it was. And those are huge. They suck a lot of money out of the economy if food, and they go hand in hand because people don't realize this, but you expend a lot of gas and energy to move food around and to process food and to do, we move a ton of food around all over the U.S. But if you look at the trend of this, inflation is basically, it looks like almost we're going to get inflation under control without crashing the economy because we're not in a recession. As a matter of fact, growth is, the jobs report came out a few weeks ago and it was fantastic. A couple 100,000 jobs created. Right.
So we know that those are going to be adjusted, but still we are looking at more jobs. There are a lot of jobs being absorbed by the economy. There are some employers that are kind of pulling back. So we're finding kind of like that Goldilocks spot, right, where unemployment is going to be around a number that is going to be tolerable for the Fed, as will hopefully inflation, and that means that the Fed is just going to stay its hand and let the economy sort of grow at its own pace. And that's a good thing. I mean, it is possible and probably even likely that the Fed will probably raise rates maybe one more time, maybe even two more times this year. But right now, the Fed is taking a wait-and-see attitude, which is a good thing because, like I've said before, the economy is massive and it takes a while for the medicine to work. So I'm very happy to see that the Fed is being a little more patient now and waiting for the medicine to work.
Here's another quote from the article. Inflation likely has further to fall. Here's more good news. Even lower inflation rates are in the pipeline. Rent was a big driver of inflation in June, but people signing new apartment leases this summer are seeing smaller rent increases they did a year ago. So rents are up, but not as much.
Right.
Okay. So what we did is we found this chart. Now this chart is the notable increases and decreases that made up their large part of housing, of inflation. Okay. So that top, those are notable increases. You can see admission to sporting events has the highest inflation, especially here in Vegas with the Golden Knights, since they're Stanley Cup champs, the tickets are more. Tomatoes, 2.8%. That was kind of a random one, like, okay. Car insurance, 1.7%. Rent, though, 0.5%. That's a big one because, remember, that's of a large dollar amount. So, and remember, that's only 1 month. That's May to June, okay? but so annualized that's still 6%. So, but 6% is not out of being ridiculous, right? Isn't historically rent increases 2 to 6%, somewhere in there? Rents increase.
Rents do increase, and rents actually tend to increase more like 6 to 8%.
Okay.
So, that's very encouraging to see that rents are increasing at a much more manageable rate.
Airfare down 8%, but remember, airfare is up 30 or 40% from a few years ago because there's less capacity now because of the pandemic. And then, of course, of eggs, that was crazy. Remember how eggs were like super expensive? It's funny because you go to Costco and the price didn't change, but they would only let you buy one like big. We would buy the big tray of like 48, or it was a massive tray. Remember that?
Right.
You could only get one though, but the price was the same, and everyone would complain about going to the store and paying like a lot of money. But you know what's on here is the cost of homes, other just rent, because the cost of homes basically year over year is like 0.8, 0.9% up nationwide. It's up a little. So it would be like 0.1%. So it's not a notable change, but it definitely looks like the raising interest rates choked off the increase in housing. There were certainly some notable ups and downs, right? There was some, because remember Austin, which has had the biggest decrease, I think they're down 13% from the peak. But remember, they were up 60 or 70%. Remember, it was ridiculous there because so many people flooded in and pushed home prices up.
Right. So this is going to be interesting because, with this kind of news, you would think that people would go out and buy homes and, thinking, well, there might be one or two more rate increases, but what happens after that is the rates start coming down. So, I'll just refinance and just kind of suck it up for, a year or two and it'll be fine. But people can't really do that, and we've talked about this before, because there isn't inventory. It's very difficult to find a home that fits people's criteria, people's needs. So a lot of people are just sitting on the sidelines and waiting, not necessarily for interest rates to come down, but for the right house to come along.
Yeah, I agree. Now I'm going to put this last chart up. This is the 10-year treasury. Now, this goes all the way back to 1980. And the reason why we're showing this is to have historical perspective. The 10-year treasury at a whopping 3.854% actually was down. It says 0.007, but it's actually down a little more today. Is actually historically super low. Now, yes, if you look back over the last decade, it was probably hanging around 2.5%. And of course, during the recession, when you could see how low it was almost zero. It was such a low number. That's why people are getting these, sub 3% rates on mortgages. But I think we end up, this is what happens, that you basically can add 3% to this, and that's what interest rates are going to be for a mortgage, okay? So it makes sense if you look at this. You have 6.8% is probably what you get at 30-year fixed. FHA and VA is a little less, jumbo's a little less, portfolio loans less, and depending on your credit score, you may get less, right? But what I foresee happening is this thing going back down to like 2.5 or 2, which gets us back to the 5.5%. And then I see all these people who got the over 6% rates refinancing.
Right.
And I think when that happens, the amount of homeowner wealth is going to be so strong. It's literally going to be very difficult. I think we're going to see home prices move less, but I think they're going to be extremely difficult for them to drop, because it's highly likely, looking at what inflation's doing, that this is lags probably by 5 or 6 months. So I think if we see inflation keep dropping, I think this 10-year treasury starts to drop over the next year. And, like a bunch of mortgage people I've talked to, they're higher level people that do like economic planning have said they're planning, like they're literally planning for, the 5 to 5.5% refi boom in about this time next year.
Right.
Much lower rates. So Juana, what is this all like with housing? Like you said, right now the problem isn't not really rates. Affordability is kind of lousy right now, not as bad as it was in the 80s. But where does this leave us with just the supply of homes? Like there's just not enough homes. Because if you knew for sure rates were going to be 1.5% less a year from now, I think far more people would run out there and buy. suck it up for a year and then refi and knock $400-500 a month off their payment.
Right. But at this point, I think it's a chicken and the egg problem. So people who would like to go out there and buy have a home to sell, and they don't want to put their house on the market to sell it because there isn't inventory out there for them to buy. So it's kind of this vicious cycle that because they have nothing to buy, they're not going to sell. So if they're not going to sell, no one else has anything to buy. So at some point, somebody's going to have to blink and move forward.
Okay, this is a trend I'm noticing. And I haven't seen it, I don't think, this much before. Historically, when somebody sold their house, they would have a mortgage, and they would when they moved, they would sell the house, take the equity, roll it to the next house. I'm seeing a lot more people who have their homes paid off because interest rates were very low, and their mortgage payment, maybe they did a 15-year or something, or they made extra payments and they paid it off quicker.
Right.
But
the people with the paid off homes are not going to sell them. Those people are going to become those accidental landlords that we've talked about before. So those people are not going to sell their homes. The people with really good interest rates, those people are going to really have to do some soul searching and figure out, can they swing buying another house and renting out their current house, because they really don't want to give up that sub 4% interest rate either, and they would rather be landlords as well. So it'll be interesting to see how that actually unfolds. We do know that builders are trying to bring some inventory to the market, but that takes a lot of time. And in the meantime, people need to buy a house.
Okay, the other thing I've noticed is people with the paid off houses are they're buying their next home for their family or whatever. Move up home, move down home, move sideways home, whatever you want to call it. They are not selling the way they used to. We used to do this thing in real estate where, like 2003, 4, 5, if you met somebody who said, hey, I'm thinking about selling and buying, that was 2 deals.
Right.
Because you would say, okay, this is what we'll do. We'll get your house in the market. We'll get under contract. We'll go out and write the offer on the next one. And we'll just get you moved from house to house. You'll sell the one, move the equity. We would make it happen for them. And you would get 2 deals. We're not seeing that now. What we're seeing is, oh, hey, I want to buy this house, but we're just going to make this one a rental. You're not going to sell it. And so the number of transactions for agents are down. The other thing I'm noticing is people that have a mortgage are saying, hey, I don't want to give up my super low payment. So this is what I'm doing. I'm going to get the house with as little money down as I can put. And then I'm going to use the excess rent payment, the difference between rent and my mortgage, to help me cover the mortgage on the new place until rates fall, I can refi. And then what I'm going to do is I'm going to start taking all that income and start paying off this loan. So they're not borrowing against the house, because that's what a complaint a lot of people have is, oh, but Todd, people are borrowing against their house and they're sucking up all they're not. We have the data. The amount of equity people have is increasing like crazy. What people are doing is they're using the excess rents they're getting on these properties and reinvesting that money into more housing. So it's making it harder for people like, that are out there just trying to buy their first house that, that don't have a ton of money to put down. They're just putting down, 3.5%, maybe trying to get FHA loan, and they're competing against someone who's got 20% to put down.
Right. And then that also means that the people who have more money to put down are less sensitive to appraisal values. So that makes their offer more attractive than somebody who has a lower down payment and is a lot tighter on the cash.
Okay. Prediction here, interest rates tank, housing some inventory comes up, but it gets sucked up as soon as it comes on the market. And we're sort of in this thing where real estate doesn't really go up and down. I think it goes sideways for another year. And then I think all hell breaks loose again when interest rates drop. I think we're going to see prices go back up. So it's basically, we said this a year ago. We had people tell us, I'm going to save this video and I'm going to show it to people and laugh at you, how you were wrong. And we've exactly called what was going to happen over the last year. I think we're right over the next year too.
Right. I mean, we've said that the market would be stable and boring for the year. And basically that's what it's been. It's been really stable and boring, which we like stable, boring markets because no one likes drama. At least we don't. And we all like to be able to plan our lives on something consistent.
And for the people who go, but Todd, year over year, minus 6%, 6 months, it's up, and 18 months, it's up. It's only down from that ridiculous frothy month of June of last year, where home prices sort of spiked one month, if you take that month out and look at the rest of the time, the market has moved exactly sideways for the last year in Vegas and then actually most of the country.
Right.
Even though 70% of markets home prices are up year over year.
Right. So that's what's going on, and we do think that hopefully the run-up of inflation has run its course and it's on its way down, and it won't rear its ugly head anytime soon. Let us know what you think. What are you seeing out there? What's your sentiment regarding interest rates and regarding inflation? You don't have to agree with us. We appreciate everybody's comments. Please like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.